Broadcasting from the commodity capital of the world, Zurich, Switzerland, this is Insider's Guide to Energy.
Welcome to Insider's Guide to Energy. I'm your host, Chris Sass, and co-hosting with me today is Niall Riddell. Niall, welcome back to the program.
Hey, Chris, how are things?
Things are going well, and we are going to talk about financing in today's environment. And, being in energy tech, that's on pretty much everyone's mind that I talk to these days. I don't know about you.
Yeah, fundraising in the current market climate. We're in a bit of a recession. Things aren't looking quite as rosy as they used to. It's a challenging market environment.
Well, I think you're projecting. Why don't we bring our guest on and see what he has to say, because he may have a different feeling. Juan Muldoon, welcome to the program.
Hey, Chris, thanks for having me.
We're excited to have you on the show. You heard a little preamble of what I think we might be talking about, but before we go there, why don't you let our audience know who you are and what it is you do professionally?
Sure. My name is Juan Muldoon, and I'm a partner at Energize. Energize Ventures is an asset management firm. We're based in Chicago. And we invest primarily in software that's driving the energy transition. So think about those two big circles, software on one side, climate on the other. We invest at that intersection, and we partner with entrepreneurs from the earliest stage, so Series A, Series B, and Series C out of our ventures program. And then we have a growth investments program as well that can continue to deploy equity into companies all the way through to IPO.
And so that growth stage, typically, I associate that less with software companies and more with people doing something with tangible hardware or long development cycles. Is that more where it fits, or is it also pretty applicable in the software companies you're funding these days?
Yeah, so the entire platform is only software, right? And we see growth actually playing a big role as a lot of these software companies continue to need capital to scale, because they're still, especially in our market, still investing into growth. So, software companies right off the bat obviously have much higher gross margins. They have, a clearer path to profitability. They tend to be much more capital efficient, which is one of the reasons that we love them. But even through, the later stages of development, they are still requiring capital because they're leaning into that growth before, kind of shifting to profitability.
This sounds incredible. Surely everyone should be investing in software companies right now. And yet we seem to have had a little bit of a tech dieback going on. What is going on in the investment climate right now?
Great question. So I'd say there's two things. There's definitely a broader market pullback. If you look at the public markets, or even if you look at generalist investing in the venture space, there has been a rapid sort of decline for 2023 compared to the craze of 2021, 2020, even 2022. That's generally the case. I think within climate, we've actually seen some buoyancy there. We've actually seen a lot of interest and a lot of investors that want to invest more directly into these themes. And frankly, it's been a space that has been quite resilient. We have not seen a drop off, at least in the demand. Now, it's still down compared to prior year, in part because prior years were so there was just so much volume and so much capital being put to work. I think we've normalized a little bit, but there's still a lot of strengths. And so maybe let's just to put it into numbers. There were over $13 billion in climate tech funding in the first half of 2023. That sounds like a big number, right? That would dwarf what it was in 2005, 2006, 2012, 2016, even when we started Energize, and yet it's still down over 40% compared to the prior year.
So 2016, you started this journey into climate tech. What was it like back then? I mean, 13 billion is a decent sized number, but were there lots of investment opportunities back then, or was this really nascent?
It was still not obvious. In fact, the whole concept of climate tech hadn't really been coined as such. We had seen the early rise and then precipitous fall of clean tech in the sort of mid to late 2000s. And then really kind of everybody that had invested in the space, unfortunately, there had been a lot of losses and people retrenched. And so there was not a lot of activity. You saw it being really more framed as energy transition or more industrial digitization. But clean tech was still kind of a four-letter word, and climate tech hadn't been really hadn't entered the public narrative. So it was a very, very different place. We saw much fewer investors, fewer opportunities, I'd say. Although, frankly, we saw really fantastic companies that are now the leaders in the space. So there was no lack of really good opportunities for us to invest in. It was just different than today.
So as a consequence of like having made some of those investments early on, you must have some pretty interesting businesses inside that collection of yours. Portfolio, stable, whatever you want to call it. Could you let us know some of the businesses you might have invested on early, and how are they getting on?
Sure. We were fortunate to back some incredible entrepreneurs early in their journey in Fund 1, which we started deploying really in 2017, 2018. We were in force. A company that you and your listeners will be very familiar with is Aurora Solar. It's a software-only tool to help installers basically design rooftop solar installations. We led the Series A and have been supporting the company through multiple rounds of financing since then. That's an incredible example of a market that was big, but maybe not growing as much at the time. And that was totally not obvious for the generalist investors. We had a prepared mind. We knew exactly what we were looking for. We were thrilled to have the opportunity to partner with Chris and Sam at the time. And that's been one that has definitely eclipsed, I think, most expectations for growth, simply because investors sometimes fail to realize that markets can expand exponentially, just like companies can. And if you can find a company that is tagged to one of those exponentially growing markets, and you're able to have a very defensible model with an incredible product like Aurora did, some magical things can happen.
And so that's a solar company. We're seeing a big boom. Niall's in the EV space. He and I do EV podcasts together. What are you seeing in the EV space?
Actually, a very similar setup within the EV space. So we talked about exponentially growing markets. We actually think that the electrification of transportation is one of the most important and biggest transfers of joules of energy that we're going to see in our generation. You have a very large need for charging infrastructure. Just the infrastructure alone is going to require hundreds of billions of dollars worldwide of deploying capital. You're seeing market-wide growth rates, compounded annual growth rates, well above 30%. The technology is not just readily available, but it's also rapidly improving. And it's powered by advances in a lot of other kind of adjacent fields like software, right? So you have a very positive, mutually reinforcing sort of loop. And one of the things that I love about the EV infrastructure world today is that these are digital assets, really, right? There's a digital backbone that is required, and we can actually get more out of these assets at the individual level, at the cluster level more locally, and potentially even at the system level. So software we see is really the secret ingredient to help unlock a lot of that growth. Sorry, go ahead.
So you just mentioned, I didn't mean to cut you off, but what's coming to my mind right now is solar, EV. These are a little bit in the U.S. Wild West spaces. It's really early. There's a lot of really interesting companies and startups and ideas. So when you're sitting across the table and someone's pitching you, how are you figuring out, we don't have consolidation yet, right? We're still in the Wild West phase. So how are you making calculated bets in software companies in this kind of environment, this kind of hyper growth or potential growth?
Yeah, that's a great question. Let me first maybe frame with one of the mental models that we use at Energize that basically follows how technology penetrates these sort of industries, because I think it's helpful as background. The first massive sort of learning curve or first wave of technology, thinking about energy or industrials, is a hardware learning curve, right? You have rapid cost declines that are driven by manufacturing and scale. Think about cleantech 1.0, right? Hardware learning curve. Most of the hardware will eventually become commoditized, and the market share will accrue to the lowest cost provider. So that's sort of phase one of technological innovation. We don't like to play at that phase. We're software investors, and so that's a required phase, but that's not where we really have an edge. The second learning curve is a business model innovation phase, where you have some new ingredient that is incorporated with, and it might be distribution, it might be a way to finance, it might be a way to lower some portion of the cost to deliver or to service these hardware assets that are now. And so that compresses the unit costs, but the soft costs actually end up making more of the overall cost of the asset, right? And so we think that's actually a very interesting place to play, especially where you have software plus services. You can have some magic happen. And the third and most exciting phase for us is where it's really software enabled scale. So the soft costs have exceeded, let's say, 50% plus of the overall unit cost, which drags a little bit the profitability around the value chain. And this is exactly where software can actually play a difference, right? This can be where a really good software tool can come in and help eliminate or at least reduce some of those soft costs. And we saw that in solar. We saw that with batteries. We've seen that with wind assets. And we think that we're going to see exactly the same thing with electric vehicle infrastructure. So if the first wave, let's say that hardware learning curve, maybe that was Tesla, right? The second wave might be something like EVgo or Electrify America or some other company that has brought a slightly different business model. We think the third wave of that software-enabled scale is where some of our investments are beginning to play. So Smart Car, which is an API system for connected vehicles. Monta, which is really the digital backbone for a lot of that energy infrastructure. And so for us, to answer your question, Chris, it's very important to get the wave right. Before we're even considering an investment, we need to make sure, are we at the time of the market when the market itself is ready to adopt and to scale these software solutions? So we have to get that right, first and foremost.
So hearing that story is fabulous because it gives some structure as to where you might be doing your investments. But behind that, there must be an overarching thesis as to why you're investing in climate. My personal experience was going through a whole bunch of time with the Committee on Climate Change. We wrote some carbon budgets. We realized climate change was very real. Technology is a big part of the answer. What was the thesis when you sat down in Energize to go after that climate space?
Well, that was really it. This is a large market that is obviously going to continue to grow, and we saw sort of the three Ds in the energy market. We believed that the energy market was going to be more decarbonized. That train had left the station, right? This was not a political question. This was not even a cost question, right? Wind and solar were already cost parity. So it was going to be decarbonized. It was going to be more decentralized. We're going to go from the large central power plants of the past to much more decentralized distributed assets. And that requires a complete shift from a product perspective, right? And then the third is, and I think that this is very consistent with the EV theme, is that these were going to be more digital assets, more digital enabled, right? And there was going to be a software layer on top that would help us optimize the deployment of these assets, that would help us optimize the management of these assets, and that was going to continue to accelerate that trend. That was the thesis from the very beginning.
And now, have you seen what I think I see? I don't know if my sample size is big enough, but in my community of friends and founders that I work with, many of us started in telecommunication and other technologies because the statement you just made about distributed energy and the scale and all that is very analogous to the communication networks that we built in the past.
Absolutely.
So is this a trend of the founders that you're seeing that are coming to you? Are they coming up through the ranks of Silicon Valley and other tech companies, or are they coming from the energy industry?
That's a great point, and I would say both, actually. Many people believe that the energy world or the energy problem, the climate problem, is going to be solved by energy entrepreneurs. I think that that's true. We will all have a hand in it, but there's a massive amount of technology that is actually either born in other industries that we can use, or that has, maybe it's cross applicable, right? So we see this sort of leveraging of other industries really in three ways. Number one, technology. So examples from our portfolio, something like Drone Deploy, which is a software to manage reality capture across different either aerial or ground drones. Their primary use cases were in the construction and the insurance business when we invested. We actually had a point of view that specifically utility scale solar deployments were going bigger and bigger and bigger, and you needed more and more technology to help manage the construction process, manage the operations and maintenance. You needed, sort of a different level of scale. And we thought drones was going to be a fantastic use case for that. We actually introduced the drone deploy team in part to the renewable energy industry and said, hey, this is a market that needs your solution where we can help you break in. And today it's over a third of their revenue base. So there's real opportunity for technology that is already deployed in different kinds of markets to have an impact in our space. So that's number one. Talent, I think, is the other, right? You mentioned it, Chris. We see more and more talent with functional expertise, particularly around scaling enterprise SaaS companies coming into the climate space. We love that. I think that's fantastic. If you're able to take somebody with real chops on go-to-market or marketing or sales, let's just make sure that we're selling the right thing, right? But that's a really good one. And then I think the third one you've just mentioned, which is that markets kind of tend to rhyme, right? And so we've learned a lot from telecom, construction, industrials, not just that what are they using, but what do the adoption curves look like? What do the deployment curves look like? How do the customers and competition really start to converge as these industries scale?
And then what kind of returns do we expect in the energy space, right? So I could tell you what we did in telecom. I can tell you what we did in other tech. And it was pretty aggressive in the heyday. We're kind of in a boom. I mean, yes, you say it's down, but it's still a pretty happening spot, and there's a lot of money
for sure
into it. What kind of returns are investors looking for, and what kind of exits are they looking for?
I can tell you what we're looking for, and maybe not to generalize beyond that, but we're venture capital investors. We're financial first. And so, our goal is to return at least 2 to 3 times the fund in aggregate. So anytime that we're making an investment, obviously we're adjusting for risk. And so our expectation is that, the folks that we're investing behind will be able to have a 5, 10x return from our point of entry. I think that that's totally doable. These markets are big and growing, and technology is moving the needle. And I think the second layer of that is, well, how much capital does it take to get there, right? Which is part of the reason, going back to the why software, which is part of the reason we occupy that space.
So Chris and I both had some experience running around in this space, speaking to VCs and trying to get the attention of VCs. You've clearly seen some pretty awesome companies, and therefore you're the kind of person that we'd all love to speak to. What is it that tech founders out there should be like presenting to you? What is it that makes someone stand out from the crowd so that you go, I must speak to these guys? And then even better, what makes you then go from this is interesting through to, yes, I'm convicted that this, I've got massive conviction, this is going to be a huge space, great team. What is it that really makes you tick?
Yeah. So I'll give you the answer in 2 parts. Number one is sort of what is the rubric that we evaluate opportunities on, because I think that will show some light. And then maybe what is the X factor that historically has made a big difference. But on the first side, we have a rubric that we follow, which is we evaluate product, market, team, economics, deal, and then the last one is I for impact, right? So what is the impact that this is going to have in this transition? Obviously, for product, you're looking for something that works. You're looking for something that is defensible, right? And ideally, you're looking for something that is going to have a compounding advantage in time, right? Market, we tend to know our market's cold just because this is the only thing that we do, right? We're laser focused on this energy transition and sustainability. So we'll have a very prepared mind on the market because we've been driving that conviction through our research process for multiple quarters. But we'll look for what is the competition, what is the likelihood of obviously substitutes coming in, et cetera, et cetera, et cetera. Team is super important. At the end of the day, we're investing in people, and we need to see that these leaders are not just tourists. We want to have folks that we're working with that have the expertise, are able to attract more talent, are able to attract more capital around them. Economics, we've talked a little bit about that, and we can double click into it because I think it's really important. The metrics are a little bit different, right? We're looking at SaaS companies primarily. And so, obviously we're driven by gross margins, we're driven by net dollar retention. Those 2 things are probably the most important things that entrepreneurs should be focusing on. But obviously there's growth and there's, average price per user, there's all the other metrics that you would expect, right? For health, for fundamental health of the business. And then, obviously can we structure something here that will meet our return expectations is very important. So that's sort of the big kind of framework, right? I think that there's three razors that I fall back on a lot when we're bringing in things to investment committee, and it's the three C's. Number one, does this entrepreneur and team have commercial respect? Respect for the industry's sales cycle, focus on that commercialization, not just the technology, but how are we getting it to market? How are we actually delivering a product with economic value? CEOs that understand the use cases, that understand how the customer ticks. That's really important for us. The second C for me is customer validation. It kind of follows the first, right? We want to see revenue. We want to see, ideally, that revenue go through at least one, if not two, renewal cycles. We want to make sure that the quality of that revenue is persistent and that it's not just a pilot program or that it's not, some innovation budget, but that there are real business initiatives that are tied to this particular technology. And then the third C is capital efficiency, right? We need to be able to withstand a longer sales cycle in energy traditionally. And so we look at things like the burn multiples. We look at things like, obviously, the gross margin story. We don't mind if we're investing a little bit into sales or rather into customer success and maybe dragging that gross margin down, so long as we're seeing it on the back end in terms of account expansions, in terms of better net dollar retention.
An earlier question, you said something that made me think maybe you guys are active investors. I think you talked about bringing a company into the energy space as an investor. Mm-hmm. How active do you think an equity partner should be? So when you get in, are you bringing your leadership team in and helping the leadership team? Are you in the day-to-day, in the quarterly meetings? What's your level of engagement?
I would say we have a pretty high engagement, and our goal is that we can lead to better outcomes because of Energize's engagement. That's the point, right? We don't want to make an investment in a company that we don't think we're going to be able to positively influence. Full stop, right? How do we do that? Well, we join boards. On every single one of our new investments, we take a board seat, sometimes two board seats with an observer, because we think that having that relationship and having that impact is important. We work very hard to earn the first call from the CEO. Good things, bad things are happening. Hey, what do we do? That's different from just a board seat, right? That's a different level of engagement. Oftentimes, we have CROs in our portfolio that have my phone number, right? And we're getting the direct line to the executives, which is really fantastic. And then the other thing that I'd say is Energize has built very deliberately a whole team, we call it the Edge platform, of functional experts that can drop into the portfolio sort of on call and help either troubleshoot something or set something up for the first time with years of experience selling and scaling software companies, right? So just to bring up one specific example, we have a gentleman in our team called Jeff Schmidt. Prior, he was Chief Revenue Officer at Drone Deploy, another of our investments. He has 2 decades of experience building and scaling go-to-market teams and motions, which is a super critical function to get right in the early stages of commercialization and kind of company development in the energy space, right? And so the fact that we can have Jeff, who can work with an entrepreneur that maybe has been focused on sales but hasn't built out a team around him to be able to do that, right? Well, what do you even look for? Where do you start? What should the right motion be? What should the quotas be? All of those different things that an experienced CRO can bring to the table, we can bring as a platform.
That's really cool. So we've got an investor who understands the space. You've clearly identified that we're going through a little bit of a tough time at the moment, but we know that we have to do more in the climate tech space in order to enable our energy transition and enable us to get to this cleaner outcome. What kind of things do you see coming forward? What excites you as we look into the future of investment in this space? And how do you see this landscape changing as we now have these higher levels of renewables? We now have this technology emerging. What's happening next?
Great question. I think that the only constant is change. Right, we think that the technology or the energy transition will continue, and then it's just a matter of how well and how much does software penetrate, and how can we extract even more value out of that. To be more specific, there are underlying trends that we think are going to play out over several decades that we're still in the very early innings of as an investable opportunity for us. So we've talked about solar. I think there's a lot more that we can do in terms of solar bringing more efficiency, or software bringing more efficiency to that specific technology, less in the leading derivative and more on the kind of like mid-level to lagging derivative potentially, now that more and more software is deployed. Batteries is another fantastic example. We've been following this space for 7 years, since our firm inception, and we held out on making any investments in battery technologies in our first fund because we thought that the market was kind of coming and always around the corner, always around the corner, always around the corner. We ended up actually making an investment in a company called Twice out of Europe that does battery analytics, so the software that's actually used for advanced battery analytics. That's more of a leading derivative play, right? The battery market is coming. We want to be on the front end of that deployment cycle. Electric vehicles and EV charging, we've talked about. I think that is going to continue to be a very important portion of our thesis. So software that is tied to the electrification movement, the electrification of really everything, DERs, all those things are squarely in our sights right now. We're very curious about how we, as a system, solve some different questions around it. So labor is a big bottleneck these days. Can software help us enable more of that, whether that's through technology for training or technology for workforce management? That's something that we have our sights on. The carbon economy overall is still a very nascent space. A lot of the digital infrastructure that's required for that to flow properly hasn't been built yet. And we're very excited about where that's going in the next couple of years. And I'd say the other thing is there's a lot of maybe simpler workflow automation tools, other kinds of things that maybe cut across multiple industries that can help maniacally reduce those soft costs that we've talked about. We've spent a lot of time and actually made an investment in a company called Banyan in the intersection of finance and renewables. So all this capital that's coming into the space, there's a ton of soft costs associated with it. There's a ton of places where things get stuck literally behind emails and paper and just processes that can be automated or made more efficient with software tools.
So you've talked about a couple of the investments that you've made, and they feel to me like they're North American, European. Do you look outside of those markets and see what's going on across other parts of the world to understand how you see trends changing, and how do you position the different markets? Because I'm sat here in the UK. We always like to think we're a bit of a leader in offshore wind. Do you look to the UK for that sort of stuff, and then you look back to other countries for other technologies?
Yes, we do. So we're not geographically constrained in any way, other than, I guess, how quickly I can get from here to Zurich or wherever it is the next opportunity will take us. So we have about 25% of our investments have been in Europe. We have companies across Europe, and we're happy to go there primarily for the reason that you've mentioned, right? Which is those markets from an energy perspective are much more developed. I mean, let's look at the EV space, for example. We made an investment in a company called Monta, which is based in Copenhagen. And we love the fact that they are not just playing, but winning in the largest, most mature market right now, which is really Europe, right? But we'll go anywhere. We've looked at a couple of companies in Latin America, have not come close to an investment there. We have an open sort of deep dive into emerging markets and how can emerging markets use software to leapfrog some technologies in the energy transition. And we're seeing some interesting things there as well.
So when you go into a market like Copenhagen or somewhere in Latin America or South America, are you investing for a global play, or are you willing to make a regional play as well? So might you have charging infrastructure in the UK, charging infrastructure in Denmark or somewhere else, or would you consider that competitive within a portfolio?
I think you need a certain level of scale. So we wouldn't invest in a company in, let's say, Denmark, and then the next thing in Germany doing the same thing, right? Those are probably too close. The company that I mentioned, Monta, will be a global player. We will expand into the US, and part of the reason that we're excited about that is we think that there's a much broader, bigger play there. We have not run into sort of the geographic boundaries, I guess, for an investment. Maybe part of that, Chris, is because software is kind of global and globally distributed, and it's hard to have like a really built out moat from a geographic perspective.
Hold on that note. It is and it isn't. So Europe's got some different legislation and protections, and so running a software as a service company in both North America and Europe, there's quite a bit of nuance to doing it. It's not super easy, right? The software is easy to make work, so the technology is easy. It's the politics that are hard.
For sure. I guess my point is more, if you're building a software company in Utah, it's not like you can't take that to New York.
Yeah, of course.
And if that software company works and scales and you're able to deal with some of the different jurisdictions, you can easily deliver it to Switzerland, right? Much more than if it's a hardware or a local services business.
And then are you seeing some trends of, so, Neil, I think, broaches of what's coming. So are there trends in the software, or trends like is AI now, since it's a current buzzword across everybody's, or is that suddenly something that people are rushing to invest in, or is that, what trends are you seeing?
Yeah, specifically on the AI question, it's sort of dizzying, because I mentioned climate as being pretty resilient. I think the other pocket that has seen a lot of interest is like anything that has to do with AI, right? And you put those two things together, and then it's like, oh my gosh, what are we like? First of all, what is it really? Like, is this really AI, or is this just more advanced compute? And then, people's imaginations, I think, run a little bit wild, which is great, right? Like, at the end of the day, great technology, I think it's Josh Wolf that likes to say, great technology is indistinguishable from magic, right? Like, there's so many things that AI can do at a very advanced, rate that you need teams and hordes of people to be able to do. So I think that there's a lot of interesting use cases. On the flip side of that, we've been investing in that for years, right? Aurora, the company that I described earlier, has very advanced analytics for positioning and for optimizing system design. But that's not why we invested in it. It's not like, oh, let's invest in this because it's AI. It's, well, let's invest in this because there's a massive problem here that can be solved, and there's a really great way to do it, right? That's kind of how we like to think about it.
So another tech that had a bubble, and still people in North America talk about it quite a bit, have a lot of hope for it, is blockchain.
Yes.
So, if we're going to talk about all the elephants in the room, what's up with blockchain? What are you seeing from the investor side? Are you seeing new companies coming out with it? Are you seeing your past investments in it paying off? What do you think?
We very deliberately stayed away from a lot of the blockchain applications. You'll remember in 2018, I think it was, and I'm happy to share some of our research from back then. But this was the panacea, right? It was, if you just took an empty napkin and you sketched out, well, energy markets are highly distributed, and there's regulation, and there's payments, and there's all these things, and you've got commodities that you can track and trace, and you could use it for everything and for anything, right? And there were a couple of I think well-funded companies at the time. It was always the poster child, I think, for a great technology idea that was desperately searching for a problem to solve. And in reality, the people that were solving that problem were not defaulting to blockchain. They were defaulting to something that was maybe not as efficient, but it was fine, right? The problem pain point match never really happened. I have not heard blockchain brought up recently, so maybe some of those companies were able to make it out of the valley of death, but I suspect that a lot of them either didn't or pivoted into serving that problem in a different way.
So we've gone from the super sexy AI and super sexy blockchain into a world which is a genuine problem seeking a solution. What do you see in the world of heat? Heat's like this mega issue. I'm in London. It doesn't get that cold in winter, but we know that British housing stock is pretty terrible. We see gas demand go through the roof. It's a massive part of our decarbonisation agenda to decarbonise heat. What do you see coming in heat?
I think heat pumps specifically are going to be, they already are capturing a lot of attention in our space. Everything from hardware, companies coming up with new and better designs, down to more software-enabled services companies, and then there's a few that are software first. I think that's a really interesting space because the problems are real, right? I think the question is, well, who's dealing with that problem, and who has the budget to actually scale? Is it going to be the homeowner? In the States, it has not been, right? Like the homeowner in the United States is hard to get that person to turn the nest down or up by a couple of degrees, because the ultimate price that we pay is still fairly low, right? The pain point is not high enough. But is it going to be that? Is it going to be the asset owner, perhaps? Is it going to be the installer? What is it, or is it going to be the OEM that somehow figures out a different wedge to get more of this product to market, or the utilities through rebate programs? I think that there are a lot of really interesting go-to-market and scale questions around that specific area that we're actually very bullish on, and we'd like to find a great investment in that space. I think that it's probably going to be geared more to who's providing that service and how can software help, almost like Aurora, rather than direct to the homeowner, because at least in my experience, you have to be really gung-ho about the energy world to care enough to really move your preferences.
But I guess we had a recent guest talk about the concept of clustering, right? So you've got EVs coming in. Suddenly I go from these hippie cars to something that I drive every day, or something that's practical and it gets me around and cost effective. Solar panels become cheap and my electricity becomes cheaper. So do you look at investing in technologies or software companies around clustering effects? Is that one of the things, a metric you consider?
A little bit. I think one thing that we like to see, Chris, is what we call enabling layers. So what are those sort of enabling digital layers, the API systems, these sort of things that help to deploy more of these assets without necessarily having to take a specific point of view on it's going to be this particular piece of hardware, or it's going to be this particular technology or geography that is going to take off. That's point number one. I think point number two, you're totally right that a lot of these are self-reinforcing decisions, right? And it's, it also comes down to individual preferences. So if you're the type of person that cares enough about energy to put solar on your roof, you probably care enough about energy to make a lot of other choices, right? And if you're not, if you're going to go for the heat pump because you think that it's going to be, eventually more cost effective at the end, or you only care about the EVs because it's a cool, sexy car, well, then it'll take you a little bit longer to make that second, sort of clustering choice, right? So it's hard to play the timing right, but I think if you can play that enabling layer, and you can get exposure to the broader growth of it, then you can be in a really good place.
A question that comes to mind in an energy tech company, by the time a company gets to, let's say, an A round or something like that, and you have your founders in there, how diluted do founders get in that world? Are they at like 10%, 20%? Where do they tend to fall in by the time they get to the company's really there?
It really depends. It depends on the founder. It depends on the specific nuances. It depends on the fundraising environment that they had when they raised their first couple rounds. I think that we like to see founders have at least 10% plus, certainly, in that A category. I mean, you should have way more than that, because we want there to be sufficient skin in the game at the end of the day, right? But funding rounds are dilutive, right? And it can be anywhere from 10 to 20 to 30, maybe sometimes more than that, but it's very nuanced. I don't think it's easy to generalize that.
So it feels like we're starting to have a conversation like a generalist investor. You speak to the tech investors and they go, hey, yeah, we invest across software companies. And for me, my heart sinks at that point, because all of a sudden I'm like, oh God, here we go. I have to explain climate change. I have to explain what it's like to manage electric vehicles. What I love to hear is something specific from the investor about what they're really good at. How do you see yourself differentiated from like a generalist tech investor?
I think that's an excellent way to show it. You don't have to spell out DERs and VPPs to us, right? We know the space, we cover the space. This is the only thing that we do. And we are laser focused on how do you scale a software company efficiently in this particular space, right? It's knowing the nuances, and it's frankly being the voice of the customer and the industry in that boardroom as well, right? We've seen a lot of other investors, and this is, but sometimes the playbook isn't the same, you guys. Sometimes a traditional SaaS playbook of, well, let's lean into burn before the market's ready, that could kill a client company with a really long sales cycle, right? And so I think that I think being able to say it's not an either or, you can be both a fantastic software investor and laser focus on this climate. And if you can bring those two things together, it could be really good. So that's one thing that I like to lean into. And then, the second, and it kind of goes back to this edge and firm support that I was talking about before, we're going to be there every step of the way. We're going to bring the full resources and full value of the firm, of Energize, to everything that we're investing behind. We have a very concentrated portfolio, so usually 14, 15-ish names per fund on the ventures side, even more concentrated on the growth side. So, we're not going to just put an option down and then, hopefully it hits type of thing before the next thing gets hot. We're in it.
So you've taken us on a bit of a journey through the recession. The climate is still a little bit more buoyant than others, a bit of history. You've given us an amazing story around how we go through waves inside this ecosystem and where you like to invest. And then you've given us some cool insights as to what investors can do to stand out. So you've given us a very strong professional perspective of the journey we've been on. But one of the questions I love to ask my investors, which is a bit cheeky, and I'm going to take this opportunity to ask it now. Do you have solar on your rooftop? Do you have battery at home? Do you have an electric vehicle?
Great question. I don't have solar on my roof. I've had it looked at twice, actually. Really cool. The last time that I had it looked at, the guy that came had a drone that was using Drone Deploy, one of our portfolio companies, to map it out. So that was really cool. But I don't have solar on the roof. Unfortunately, the way that it pitches is like too steep, and so it doesn't pencil out and it doesn't look the right way. So unfortunately, no solar. I do have as smart a system as you could get for thermostat management. And no EV yet. We have one family car, and it's a Subaru that can take all of our kids around. But I'm on the short list for a Cybertruck as soon as this thing rolls off production.
Amazing.
Well, I think it's been a great conversation. Juan, before we wrap up, is there any final thoughts that you want to do to pull this together for our audience that you want to share?
I think this was really a fun conversation, so I appreciate both of you guys having me on. Maybe the leave behind for the audience. Remember, these markets are big, and software can actually make a big difference. And maybe to say that a different way, software can drive alpha for investors and certainly big opportunities for entrepreneurs. So there's so much more to do, and we're excited to continue to be a part of it.
Well, thank you so much for being a guest on Insider's Guide to Energy today.
Great. Thanks, Chris.
For our audience, we hope you've enjoyed this episode. We had a lot of fun making it, found out a lot. If you have questions and things, drop them in the chat when you follow us on Facebook, Instagram, or you can follow us wherever you subscribe and get your podcast. We'll talk to you again next time. Bye-bye.